Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by Bull Realty Asset and Occupancy Solutions. Visit bullrealty.com. And we're talking about boom, bust, or bubble. Where are we? My guest is Jim Costello. He's Senior Vice President with Real Capital Analytics here in Studio One. And Jim, one of the things that really impact commercial real estate is the lenders and what their regulators are telling them and what they're all telling each other about the market and the economy. You talk to a lot of lenders in these groups around the country. You know, what's going on with lenders? What are they thinking today?
You know, lenders, I think, are stuck in the same world as all the equity investors. Mm-hmm. They're also looking at the world. They're looking at prices at record highs, and they're worried. You know, do I make a loan at these prices? You know, is it something where I'm going to face risks that prices may fall and I might not get repaid? So they're concerned like everybody else. Mm-hmm. The thing I find interesting at the moment, and it's a difference between the current market and the 06-07 situation. 06-07, it was a competitive lending market then as well. And as cap rates fell, so too did debt service coverage ratios as lenders competed to get every deal by cutting their standards. And today, lenders are still competing, but they're not cutting their standards as much. Debt service coverage ratios haven't chased cap rates down. So you've got some more stability there. Now, there's new entrants to the field, and that, I think, is starting to worry some of the market participants I talk to. You have a number of mortgage debt funds that have come out. Really, at this stage in the cycle, with prices so high, some investors have thought, should I be in the equity portion of the capital stack, or should I be in the debt portion of the capital stack? And if prices might come down a bit, I might be safer for the kind of low yield, kind of safe, stable returns I want if I'm in the debt portion of the capital stack. So these mortgage debt funds have got folks concerned. I've heard the term thrown out there, well, it's a shadow banking system, and worries that there might be some problems there. I think the challenge so far is most of those funds, they really can't compete on the first mortgage stuff where you'd have most of the challenges. It's just their cost of capital requires that they get a higher return. So they have to play more on the mezz and pref equity portion, and so it's a little less risky in that sense for the market overall. But these folks are out there, and they're starting to generate some activity for the market.
Yeah, and it seems like some of the lenders that we talk to, we're in the business every day, are a little cautious, and they blame the regulators. So, are they mentioning that the regulators are making them cut back or making them be more cautious?
Yeah, regulation in lending, it can be a good thing and it can be a bad thing, right? The problem is I think of it like a pendulum. You go back to before the financial crisis, arguably the pendulum was way to the side of no regulation. You had people making mortgages that had no oversight, no documentation, and sold in these packages securities that nobody really looked at. That was a problem. But then to deal with that problem, they came in with a heavy-handed fist of regulation that over-regulated things. Talking with people on the residential side of the world, what they had to go through to get a closing done now, in terms of the amount of documentation and paperwork, it's maddening.
Yeah.
And I think that that regulatory burden, it impacts commercial as well. Just look at what the CMBS world has had to deal with to try and think about how they deal with risk retention. And those kind of issues have hampered commercial property lending. Now, some of that may go away. There's talk of even some of the risk retention for commercial property mortgages in the CMBS world going away, which would help provide additional sources of capital into the commercial markets. But the regulation, it's beneficial to some degree, as long as it doesn't get too intense. And there's been people working with the regulators trying to make them understand those issues. But I think actually the folks who have it the hardest are the developers, because the developers have a real need for debt financing. And the regulations on so-called high volatility commercial real estate loans have really hampered the amount of capital going into that financing. Now that's an area I think where it's interesting where some of the debt funds are stepping up to that. That's a higher cost of capital compared to what one might get from banks. But in a way, I might argue, since construction is so much riskier, there's so many things that can happen along the way. You can run into just construction problems, find a graveyard on the site, whatever, or just have the property delivered at the wrong point in the cycle. All those things and all those risks, arguably a high cost of capital, is probably a good thing to reward someone for taking on the risks of providing capital to a startup like that.
Yeah, that's a good point. And you bring up a good point too with the amount of new supply. So if you look back at the previous recession, some would call it a depression if they owned a lot of real estate they lost, and where we are now and looking forward, there's been a lot less new supply, right? How's that impacted?
Well, there's pockets of supply,
Yeah.
and I find this funny. I mean, it's like our industry is still feeling the pain of the 1980s. We had a supply-driven downturn then, and it's like we always look back to the last downturn and said, we're always fighting the last battle.
Yeah.
But in this case, we've gone through 2 downturns where it was really kind of demand and fiscal-driven and not supply-driven, and yet people are still worried about supply as a driver of the next downturn. So I think we need to be a little less fearful of supply than we currently are. Now that said, there's a few pockets here and there across the country where supply is pretty intense. I live in the middle of one of them, downtown Brooklyn in the New York area. It was an area with a lot of 1-2-story deferred maintenance brick buildings. They've been tearing them down, building amazing residential towers. And so prices are kind of light at the moment because there's so much coming at once. But it's a location. Look out from my deck and see the Statue of Liberty and get the 2 subway stop ride to Manhattan. It's not a bad place to be.
Yeah, I can imagine. So you talk about new supply. So if you look at new supply, multifamilies had a lot of new supply in certain markets. Retail, I guess, has been through a change. But let's look at office. I think office is a favorite asset class, right, with a lot of investors and foreign investors. So what do you think about supply and values for office properties in general?
Thinking about the supply trends for the property sector, I think it's only certain markets that are able to support the pricing needed to generate new construction. We haven't seen the same kind of price expansion in the cycle in every market. The 6 major markets in the United States, saw the strongest price growth in the urban areas. Mm-hmm. Those are the areas generally for all property types, whether office, apartment, hotel, that have been facing some new supply pressures. If you are in a small industrial city in the Midwest, you just haven't had the price appreciation necessary to generate the incentives for developers to come in and deliver a new office asset.
Right. So very market specific. When you talk to the lenders and you get a vibe from them, are they certain asset classes they're a little concerned about, like maybe multifamily or retail? Or
Oh, the one sector that everybody's concerned about is retail, and it's a shame because there's really well-performing retail assets with great locations, great consumer bases, and tenants that are still in the business that are facing challenges in getting financing. All because people tend to, at the board level, paint with a broad brush.
Yeah.
And so it gets pushed down to the loan officer, hey, stay away from retail.
Yeah.
So, and that's a problem, I think, for retail that is going to be out there for a while.
Yeah, you create your own problem, right?
Exactly.
Yeah.
But it's an opportunity, I think, as well for somebody who steps in and realizes
Yeah.
there's a market dislocation. Maybe I can provide some services in the retail market where others are a little shy right now. If you're going in like a sniper and just picking out targets one at a time.
Yeah. Yeah, and you mentioned before the kind of the smaller price range properties maybe haven't been affected as much, and we saw a lot of shopping centers from like $3 million to $20 million, and they seem to be on fire. They seem to be hot. Well, we're going to take a short break. When we get back, we're going to ask Jim about the worldwide economy, some things going on around the world, and how it may impact commercial real estate in the U.S. Stay with us. This is America's Commercial Real Estate Show.
There we